Welcome to Morning Mortgages, your source for news on mortgages. Today we will look at the Federal Reserve Board's increase in interest rates by 0.75%, the sharpest increase since 1994. How will this affect the markets? Stay tuned to learn more. The chairman of the Federal Reserve, Jerome Powell, lifted benchmark interest rates by 0.75 of a percentage point yesterday, from 1.5% to 1.75%. This is the largest rise since 1994, and officials suggested that they would continue rising rapidly this year, turning to severe measures to curb the uncontrolled inflation they failed to foresee. Markets welcomed Powell's decision to leave the door open to another large increase, as many investors had urged the Federal Reserve chief to demonstrate his seriousness about combating rising prices. Following Powell's remarks, majority equity indexes surged. The Federal Reserve's move on Wednesday comes at a time when inflation is running at its fastest rate in more than 40 years. The Federal Open Market Committee stated in a statement that it is strongly committed to returning inflation to its target of 2%. Critics have slammed Chairman Jerome Powell and colleagues today for failing to anticipate the sharpest price hikes in 4 decades, and then being too sluggish to react. Critics urge that the Federal Reserve has allowed inflation to spiral out of control. As a result, equity and credit markets have lost faith in the Federal Reserve. They urge the Federal Reserve to act more aggressively to restore market confidence, claiming that a series of 1 percentage point hikes would be more effective in taming inflation. The Federal Reserve strives for 2% inflation as measured by the Commerce Department's Personal Consumption Expenditures Price Index, which climbed 6.3% in the year to April, close to a 40-year high. Based on the median estimate of governors and regional presidents, policymakers now expect the index to rise 5.2% this year, up from 4.3% in March predictions. The Federal Reserve restated that it would reduce its huge balance sheet by $47.5 billion each month, beginning June 1st, and increasing to $95 billion in September. The central bankers changed their economic forecast from a soft landing in March to a bumpier landing, highlighting Powell's difficult challenge in taming inflation that is running almost 3 times the Federal Reserve's 2% objective without sparking a recession. Powell, who was recently confirmed by the Senate for a good 4-year term, must also reestablish the Fed's confidence in battling inflation with investors and Americans fed up with the rising living costs. In yesterday's announcement, the Federal Reserve also released its most recent inflation and economic growth projections. Inflation, as measured by the Personal Consumption Expenditures Price Index, is expected to rise by 5.2% by year's end, according to the central bank. This is an increase from the 4.3% forecast in March. In terms of the economy, the Federal Reserve reduced its GDP growth prediction for 2022 from 2.8% to 1.7%. The central bank also reduced its growth forecast from 2023 and 2024 to less than 2%. As we can see, the Federal Reserve seems to have fully recognized that the problem of inflation is more than just a transitory problem. It also looks to be combating inflation via interest rate changes. So, where will rates go from here? The Federal Reserve expects the rates to rise to 3.4% by the end of the year, meaning another 1.75 percentage point over the next 4 policy meetings to end the year above 3%. From today's viewpoint, either a 50 basis point or 75 basis point rise seems to be probable at our next meeting, Powell said during a press conference after the Fed's policy decision. We think that more rate hikes will be necessary. Powell said that the pace of such adjustments will continue to be determined by incoming data and the developing economic outlook. Clearly, today's 75 basis point hike is extremely substantial, According to the dot plot of individual members' expectations, the Fed's benchmark rate will end the year at 3.4%, a 1.5 percent point increase from the March estimate. The committee then predicts that the rate will rise to 3.8% in 2023, a full percentage point higher than what was predicted earlier this year. According to the Federal Reserve's dot plot forecast, the midpoint of the target range for the Fed funds rate would be 3.4%. Here are the Federal Reserve's most recent targets, as released in a statement on Wednesday. The Fed's forecast in March 2022 looked like this. As mentioned before, despite these official forecasts, Federal Reserve Board Chairman Jerome Powell said during the news conference yesterday that the central bank could take an even more aggressive stance to combat inflation and raise rates by 75 basis points next month. So far, the markets have responded favorably to the Federal Reserve Board's hike in rates. This may be attributable to the fact that investors have increased faith in the Federal Reserve Board's battle against inflation. It is still too early to determine how the predicted rate rises would affect the property market in the coming months, given the expected rate hikes as the Federal Reserve Board announced. Stay tuned to the channel to find out more. See you next time.